Welcome back, ladies and gentlemen. Time to move on to the next session. And coming up is the most important session of the event. We call it a thought leader panel for discussing micro aspects of investing, starting from valuations. Given the fact that the financial markets have run up so much, steering the path crowded with so high valuations sort of looks very difficult. And to address the real worries of investors in this regard, I think we must now welcome our revered panel. You met him yesterday, and he's joining this panel with us, ladies and gentlemen, Mr. Prashant Khemka, founder and CIO, White Oak Capital Management. And I'd like to say, prior to setting up White Oak Capital Management Consultants in June 2017, an investment advisory firm in India, Mr. Prashant Khemka spent 17 years at Goldman Sachs Asset Management from 2007 to 2017. And also he was with Global Emerging Markets Equity between 2013 to 2017 and has won several accolades as the CIO and lead PM of GS India Equity. There's so much to talk about him, but let's extend a warm welcome to Mr. Prashant Khemka. I'd like to invite now Mr. Andrew Holland, CEO of Avendus Capital Alternate Strategies. A warm welcome, Mr. Andrew. Mr. Andrew Holland, ladies and gentlemen, prior to joining Avendus Capital Public Markets Alternate Strategies LLP, was the CEO of Ambit Investment Advisors, where he built one of India's largest and most successful hedge funds. He also was the managing director, Strategic Investment Group for Merrill Lynch in India, and he has worked with leading investment banks, those include County, NatWest in UK, Barclays in UK, and South Korea, Credit Suisse in Japan, with a total investment banking experience spanning 30 years. So I'd like to extend a very, very warm welcome to Mr. Andrew Holland, the CEO of Avendus Capital Alternate Strategies. Now, moving on to our next speaker, Mr. Hiren, the co-founder and CIO of Alchemy Capital. He started his career by working with KR Choksey and Company, a sell-side firm known for its value investment approach, and eventually graduated to become the firm's head of research. And he brings over 2 decades of vast experience in bottom-up stock picking, managing portfolios, and managing a high-performance investment team capable of delivering consistent, superior alpha. Now, these industry veterans will discuss on the most asked question today, which is, are we heading towards an asset bubble or the best decade in our lifetime for wealth creation? This session will be moderated by Mr. Niraj Shah, who is a business journalist with over 16 years of experience in the field of business journalism, where he has held the top spot in the markets coverage at various leading platforms. We are so pleased and gratified, really delighted to have him in our midst. He's currently the markets editor at Bloomberg Quint. Warm welcome once again to you, Mr. Shah. Yesterday also he moderated a session for us, and here he is once again on our request. Mr. Shah, I'm going to hand the proceedings of this very impactful session to you.
Thank you, Aishwarya, for the kind words, and to Team PMS AIF for getting together such a wonderful panel. I look forward to talking to all 3 of you. Gentlemen, good morning. And let me start in the order that Aishwarya introduced each of you as well. Prashant, can I take the first, or can I just take the opening remarks from you? I was thinking that even if you are, headed towards an asset bubble, you can still create wealth, can't you? So what do you think the next decade could hold in store?
So certainly. So the question is so posed that both outcomes are favorable as of today. If you're heading into a bubble, you don't want to get out while you're heading into a bubble, right? Too many people get out too early. Whereas, see, our philosophy at White Oak has been, we never try to time the market, always stay fully invested, because in our view, it is impossible, not very difficult. Media often makes it sound, and experts often make it sound it as very difficult, which suggests that it's doable. Our view is it is as impossible as predicting a coin flip, and we stay fully invested at all times. The money is made through stock selection, in our view. Now, over long periods of time, not just in India, but everywhere around the world, the experience has been the return from the market is generally in line with nominal GDP growth, right, over extended periods of time. And the rationale is that nominal GDP growth translates into corporate sales growth. So if you take BSE 500 or any particular index, all the constituents put together over extended period of time likely have sales growth, corporate sales growth similar to nominal GDP growth. And if you assume over long periods of time, profitability to stay stable, obviously there can be cyclicality, but over long periods of time, profitability to stay stable, then profits and cash flows would grow in line with the nominal GDP growth. And if multiples over extended period of time were to remain in a ballpark, and when you're talking about 10, 20, 30 years, even if the multiple moves by 10, 20, 30%, it's only going to add or subtract 1, 2, or 3%. The biggest chunk of the return, which would be, call it 10, 12, some percent, would be from the corporate earnings growth, which in turn, as we talked about, or corporate cash flows, which in turn is linked to the nominal GDP growth. So if you look at the decade of the 90s, where's a relevant point to start when the economy opened up? I think the return from the market was about 15%. The next decade was one of the finest decades, the brick decades, despite having Lehman crisis in it. The return from the market was again somewhere in the mid to high teens, about 17 odd percent, 17, 18%, if I'm not wrong. And the last decade has been one of the worst decades in our last 30 years, where in the last decade, the return from Indian equity market is more like high single digits, 8 to 9% time frame. Now, sitting at the tail end of the worst of the last 3 decades, I certainly don't worry about us already being at the bubble, at the peak of the bubble. Obviously, earnings growth has been also very muted over the last 10 years. Nominal GDP growth rate also has been somewhat tepid compared to the prior 2 decades, because obviously real GDP growth was higher and the inflation was higher. But let's say nominal GDP growth rate over the last 30 years has delivered about 12.5%, last 27, 28 years, 12.5%, and Sensex return has been also 12.5%. Going forward over the next decade, I think a similar number is reasonable to expect, where nominal GDP is, call it 10 to 12%, roughly split evenly between real GDP and GDP deflator. And that should then translate into similar corporate cash flow growth and similar return from the market. Even if you were to believe, I'm not in the camp that markets are, ahead of themselves and whatnot in light of where the interest rates globally are. But even if you are in that camp, let's say, then even if you shave off some 10, 20, 30% of the market multiple over the decade, then it would probably have a hit of a couple of percentage points on that 10 to 12% return that we are talking about.
Yeah, I think the term bubble is fairly loosely thrown around. Ladies and gentlemen, a bubble, in my definition, would be something when pricked corrects 40, 50%. I don't know if we are really at that level. But Andrew, coming on this argument, and the same question to you, maybe people think of it because of the optically high multiples. How would you respond to whether we are in the bubble or headed towards it?
Yeah, I don't think for India we're in a bubble. Partly because the savings towards equities is still very low as a percentage of overall savings. So I'm kind of less worried that there's a retail frenzy in the Indian market. I would suspect that's more so in the US markets at the moment. So when I think about there's been lots of comparisons to this 2003, 2007 type of era and so forth, but I think two things on that. One is, in 2003, the PE of the market was 8. I mean, it was cheap. It was hugely cheap. And that's, what you got. Now, our markets, by no stretch of imagination is cheap. But, what you're going to see over the next, 3 years or so is a huge explosion in earnings. And I think, the analysts, I'm not trying to have a go at the analyst community, but, operational gearing is something they never get right on the downside or the upside. So there's just going to be increasing earnings forecasts over the next 2 to 3 years. And that's what's going to drive the market. So in 3 years' time, that when you look back, is 22 times cheap or was it really 15 times? And I think that's where you've got to try and kind of project yourself. In 3 years' time, looking back to today, would it have been a cheap market because of the earnings growth that you were seeing going forward? I think my biggest concern, though, is what's happening in the US. And I know that GameStop has been a great sideshow for us all to watch and the Reddit posts. But, that tells me that, you're getting towards a top in terms of investor, kind of making money in the markets. It's been so easy for them over the last 6 to 9 months. That they think it's a one-way stop and it's only going to the moon in terms of what they're saying. So that does worry me. And, whichever I go back to, if you take the 87 crash, 2000, dot-com boom, or bust at that time. All of these have an impact from a global perspective. Now, nothing wrong with India, but of course, when that happens, all funds will take risk off the table, bring it back home, and that would mean a big outflow of funds from India. So those are the kind of things which concern me. Fortunately for us being a hedge fund, I can take positions which would benefit from markets falling as well, or at least hedge, those long positions that I have. But I'm less worried about India, because I think the growth engine of the world in the next 3 to 5 years is going to be Asia, led by China and India. So monies will come towards our markets, but in between time, it could be a little bit tricky in terms of some of the global excesses which I'm seeing. Whereas, even if I take the jobs report yesterday, right, which was poor, the narrative becomes, oh, so then the package has to go through at 1.9 trillion, and there's going to be more, kind of accommodative stance from. So we're just always saying bad news is good news and good news is great news. Some point that narrative will change, and it won't be the same.
And I'll dwell upon that point a little bit, Andrew, in just a moment, but let me get in opening thoughts from Hiren. And Hiren, we're talking twice in the last 7 days, but I'm not complaining, because you made some very amazing points in that post-budget conversation. Let's first get this opening thought about whether you think, if you think a decade out, that never mind near-term hiccups or medium-term hiccups, is it going to be the best decade of wealth creation for everybody, or could there be issues there?
I have no doubt in my mind that, we are at the start of what I believe is another raging bull market in India, driven by productivity and earnings growth. I think very seldom do you have a confluence of factors coming together, right? I mean, in my opinion, there are 4 important factors on the legs of which I see a very strong bull market in equities in India. One is that globally we have a context of reasonably good liquidity and low interest rates. And I know a lot is talked about that, but the fact of the matter is that it's a reality. We can't wish it away. Second, for the first time in India, I believe that the monetary start an economic growth cycle in India, which will then in turn lead to a great earning cycle in India. And lastly, I think what Andrew mentioned is that I think the fraction of savings that has gone into the Indian equity markets is so low that it can only go one way, which is up. And you mentioned about the bubble, right? You can't have a bubble when domestic investors are consistently net sellers for the last 6 months. I mean, people have, going into in November, December, people said, oh, we want to wait for the US elections to get over. We will get a great chance to invest. There will be a lot of volatility during US elections. We'll put in money. US elections came and went. The markets went up. Then you said, oh, there's going to be a budget in India, and you all know, we all know how worried people were about the budget. There could be new taxes, whether the government would be fiscally stingy, so on and so forth. And I don't want to make this a budget discussion, but the fact of the matter is that people are so concerned in this rally. And this is a typical copybook style, the first leg of the rally from the absolute lows. We only get to know in hindsight that the bottom was in March. And typically the first leg is very vicious. It is much hated, least participated. And I think the retail investors were very smart. A lot of them invested when the market fell in March, April, May. But I think they're becoming too smart for themselves. And ever since the Nifty has reached 10.5, 11,000, they've been doing only one thing, booking profits. My question is fine. I'm not saying that the markets may not correct tomorrow or the next week or the next month. They could. It's in the nature of markets to correct. But the point is, I've seen this play out time and time again. What's going to happen is that most of these investors are going to come back at much higher levels of the market. And then they will just rationalize in their head because there will be all good news about the economy and the earnings growth and so on and so forth. So I, first of all, do not see that we are in any sort of a bubble. You don't have a bubble when domestic participation is so low and people are booking profits and taking money off the table. And I think that, and we work, I'm sure Prashant understands, we work with a lot of advisors, allocators, and a lot of people who are neutral on equities. A lot of people, said, oh, let's take some money off the table, sit on the sideline. When the market falls, we will get in. And as Prashant rightly said, it's not difficult. It's virtually impossible to time the markets. And I think when we are at the beginning of a growth cycle, we are at the beginning of an earning cycle, trying to optimize your entry, looking at the Nifty levels, is probably the worst thing that investors can do.
Well, I hope this message is driven hard into people's minds. But Hiren, just a quick follow-up to you. And that is, even if we are not in a bubble, could we be headed towards one? Or do you reckon, aided by the moves by the government, least of all, of course, is the budget, but even before the budget, the PLI scheme, so on and so forth, the corporate tax cut going way back a year and a half, do you think we are set for an earnings up move, which will ensure that even if the market levels stay heady, the earnings support the valuations?
Look, Niraj, I think, there are in a market that there can always be a few pockets of overvaluation. That's quite possible in a market, right? Usually it happens in sectors where it is difficult to forecast earnings, but where you think that the runway of growth is phenomenally high, right? Because you can draw any blue sky scenario that you can. So there may be a few areas in the market where valuations could be a little frothy. I think the way investors are behaving in the IPO market, there may be some level of froth there. But that doesn't mean that the markets are overvalued or we are in a broad bubble. Yes, I do believe. And I think the Q2 numbers were an eye opener, right? No analyst, including, and I should include myself in it, nobody believed that the corporate sector will be able to deliver a double-digit EBITDA growth and PAT growth with a single-digit revenue decline. Q3 has been an even better surprise, right? And usually during inflection points, it is, analysts and company managements usually get it wrong because they're so involved. They're so looking at the picture very closely. It's time to step back and look at the big picture. And I think that, with corporate profits to GDP at 2.5%, we are just at the beginning of a big earnings growth cycle in India. Now, a lot of people make a comparison between 2003 to 2007, but every market cycle is different. I think that cycle was led by a debt-fueled corporate rally around the globe. I think the next cycle in India will be led by massive productivity gains and a resurgence of manufacturing in this country. So I'm quite confident that the legs of this bull market are based on solid fundamentals. And we should stop only hanging the coat, at the door of liquidity.
Okay. Well, for this to not be an asset bubble, it is important for the world markets to be supportive. Let's assume that that's the base assumption. Now, Prashant, I want to come to you because you made a very valid point about how the nominal GDP could be a great indicator of what equity markets do, right? And often in the last 15 years, I think people have made a mistake of looking at real GDP and trying to time the market, which is proved to be futile. My question to you is, when you at your firm look at decade out, and when you in all your interviews or in the recent note that you wrote, Vantage Point, speak about how looking at the macro is futile and it's better to be bottoms up, how do you map a decade by looking at bottom up analysis and trying to figure out what could happen, say over 5 years, if not 10? You are on mute, Prashant.
Sorry, I was saying thank you, Niraj, for reading the vantage point and reading it that carefully. What I would say is, look, we have always been wrong in the macro scenario that we've built in the company models. So where macro is relevant is when you financial model the company and project the future. So since 2006, late 2006, when I moved from US to India, and in US also we were always wrong. So it's a given that almost everyone, not almost everyone, everyone is always wrong on every company, by small or by large, right? You won't get precisely the same dollar revenue or earnings projections over that longer time period. But what is more important in our scheme of things, as well as for everyone else. So let's say 2006, we all were talking about moving on from 8% GDP growth rate to double-digit GDP growth rate. 8% was a given. It was our birthright. Nobody can take it away. How can we move from 8% to 10% or above? You very well remember, I suppose,
Yeah.
Niraj and Andrew and Hiren can probably recollect that, right? Today, 8% is a far-fetched dream, more or less, on a sustainable basis. So back then, when we were modeling, and if you had asked me the question about return expectation over the next decade, in 2006-7, to be honest, I would have said low to mid-teens, because real GDP growth rate, I would have assumed 8 to 10%, and GDP deflator of about 5%, and that would be more appropriate expectation, and that would have been very much in line with the prior 20-year experience of where India delivered 15%. So you have to recalibrate. It's a dynamic world. Facts change. You have to recalibrate. You recalibrate or mark to market, if you will. You mark to market your assumptions and financial models all the time. What is more crucial, though, is that you have to have a uniform backdrop that you build in across various sectors and across various companies. You will end up in trouble if your team is building varying different economic assumptions in the models. If an auto analyst and the auto company models assume a 8 to 10% GDP growth rate for the next 10 years, let's say, and let's say the financial sector analyst is assuming a 5% GDP growth rate going forward, then you end up with a very skewed portfolio, and the results would be counterproductive. But as long as you model a homogeneous, even if that backdrop is wrong, as long as you model it, more or less homogeneous, then the damage is not done.
So then, in which case, Prashant, my question to you would be that would you believe that ceteris paribus, some surprises notwithstanding, even if you can't map the numbers a decade out, you reckon for the near term, next 2, 3, 4 years, led by earnings growth, and if the world remains benign with the interest rates and the inflation expectations, that the earnings growth will be supportive of higher valuations? That's the key question, right? Because I think that will define whether we reach bubble territory or we just continue on the same on the same merry-go-round.
See, there are two elements to whatever time frame that you expect the returns, or you're calculating the returns or trying to estimate the returns from the market. There'll be two elements plus a small third one, but two elements would be, let's say, the change in earnings from, let's say we are focusing on, let's say, FY22. So by various estimates, market is at 22 times FY22. Now 3 years, if you were to measure 3-year return, then over a 3-year time period, and then 3 years out, we'll be looking at FY25 earnings. So the market return would be function of change in earnings between FY25 and FY22 earnings. Let's say we are up 100% in earnings, just because we are at such suppressed level and all that. Just let's be optimistic and pick a round number. Then if the multiple remains the same on FY25, then the return from the market would be 100%. And if the multiple, for whatever reason, goes down, because 24 there is an election and various other developments would take place. If the multiple, let's say, comes down by 25%, just making up, 22 multiple goes down to somewhere like 16, 17 on FY25. Then you have a situation where your 100 went to 200, and then you remove 25% from it, the return would be 50%. So the multiple is far more difficult to call. And the multiple that market would be willing to assign to the cash flows would be a function of what the macro outlook is from beyond that. And the outlook then would determine what kind of cash flow expectations and discount rate expectations would be built into the market. Today's multiple is a function of what the cash flow outlook is today and what kind of discount rates we might use to discount them. And in 24 time frame, it would be at that point in time, which is impossible. Even today's, we don't know what the market is factoring in. We can assess, but to assess what the market would be factoring in 24 is impossible.
Yeah, that's true. By the way, gentlemen, please feel free to just come in and make a point if you want to. Don't just wait for my question to come in case you want to corroborate or counter a point. So
let me jump in then.
Yeah,
You
sure,
give
sure.
me that opportunity. So, I think when we look at GDP growth, and it's always great to say our GDP growth is going 6-8% and whatever it might be, but you've got to look what's driving it, right? Because within that GDP there'll be certain sectors which are the beneficiaries or the drivers of the economy, and that's where you're going to get the biggest earnings growth. So we kind of look and say, oh, it's going to be a broad-based recovery. It never is. It's never going to be all sectors doing very well. There'll be sectors that don't. But if I take rather than looking at GDP growth, what are the big trends? It's all about trends. What are the big trends? When Bharti first came to the market, and I remember seeing it in 98, 99, when it was like 20 rupees, the vision was there. Could India, could they get the mobile services to where they thought they could be over the next decade? And that was the only thing you had to think about. Whether GDP rose or didn't really matter to that trend of what you're seeing. So, if you take the view that millennials will have the spending power for the next 3 years, right? There's 60 million millennials in the US. In China and India alone, each have over 320 million. You know where the spending power is going to be. Now, if I take Gen Z, then I'm talking about 450 million people in India who fall into that category. And my daughter falls into that category. I have no idea what she's going to spend on because she spends half of the time, most of the time on the computer. So she'll have different ways of buying and different things to buy. So if you can identify these kind of trends, whether GDP growth is 8% or not, I don't think really matters, because if you can capture those companies which are going to benefit from the spending power of India over the next decade, then you would have whether that then the PE's up 40-50 times in 5 years time. But because of companies which are now in the index, which would have huge earnings growth, is what you have to think about. So that's the way we try, and we're looking at trends, not trying to get the multiples right, because the multiple can be anything, right? I remember, when I was in the UK, Body Shop first came to the market. It was on a P of 160. Everyone said, it's not sustainable. It kept doubling year after year, because guess what? The earnings were always growing a lot faster. And I think those are the kind of things we need to kind of just take into account before we start thinking about a bubble. Think about the bigger trends which are happening out there.
Yeah, we have a body shop in India, Andrew. It's into mobile manufacturing, so to say, right now. But nevertheless, Hiren, sorry, you wanted to come in and
yeah, I just wanted to kind of make a quick point here that the relationship between macro and finally company earnings is very tenuous, right? There's no one-to-one correlation, because most of the debate that we have is usually on macro. What's the GDP growth? What's happening to interest rates, inflation? But we forget one thing, and the way at least we look at it is that I don't break my head too much on macro. But I think what is interesting to do is look at what some of the leading companies in each sector are doing and saying, right? You get a lot of understanding. Like, I don't have to make a big call on whether, agriculture is doing well, but if Lever tells me something, or if Mahindra and Mahindra tells me something, their numbers tell you something, I can deduce what is happening in that segment of the industry. I don't have to go too much at the macro level, right? So we spend a lot of time, whether we own it or not, trying to understand and decipher what some of the leading companies in each of the sectors are doing, saying, and what their numbers are telling you. I think that's a far better way to discern or distill what is happening in the macro down to the micro. Secondly, I think that most of the time is spent on trying to forecast earnings. And as Prashant rightly mentioned, we get it wrong all the time. Believe you me, we run models. I'm sure he's running models. And when we have our broad hypothesis and we say, okay, this company is going to grow ABC, and hopefully, it's a moving target, right? Because things are constantly changing. I think why macro is important, and at least, everybody who starts as a bottom-up stock picker, saying, I don't care about what's happening in the big wide world. I'm just concerned about what my company is doing. But I think the world has become more complex. You need to understand macro just to set the context right? And then you focus on what the company is doing. So first of all, it's very difficult to predict earnings because you more or less get it wrong. Secondly, I think what is more important is to understand how company management respond to different situations, right? And a lot of people tell me, what do you think, when you buy a small cap or a mid cap, which is not very well recognized, how do you know whether the earnings are going to be good, I said, well, I draw an analogy like you hiring an employee. What do you do when I hire an employee? You have a CV. That's like me reading the annual report, the balance sheet, the earnings transcript, right? Then you call the candidate for an interview. Maybe you do 2 or 3 interviews. You ask questions. That's like me talking to the CFO or the CEO of the company. And then you try to take a judgment call on the person and say, okay, I think it ticks all the boxes. Then you do reference checks like what we do in our business, channel checks. So you go and ask a competitor, dealer, customer, right? You try to get a sense of what is happening. And then you think you know it all. So you buy the stock, just like you hire the employee. But the fun start after you hire the employee. Then you see what are his strengths. You see him work day in and day out, under pressure, in good times, in bad times. And the true character of a person comes out. Investing in a company sometimes is very much like that. No matter how good you think you understand the business, the true character of the business, you will only get to know over a period of time. And that's when you start building your conviction, in the story. So I think it's, we try to, because you want to explain it in a very simplistic manner, but it is not that simple. There is, and sometimes macro may be more important for a business than micro. Sometimes micro may be very important for a business. If a company is turning around, I don't care about the macro. It's the delta change in the business which is going to drive the earnings and the stock price, right? More than macro. So I think, it's a little more complex than we all think, but I think, it's very important to, as Andrew rightly mentioned, it's important to get the direction right. It's important to get the trend right. If you think there is a tailwind, it's much easier to make money, and then you pick and choose.
Okay, so what, 35 minutes, and yeah, Prashant, just saying that 35 minutes for you established that the trend is upwards, but yeah, please make your point.
So just to add to what Hiren said and to clarify a little bit what I was saying, and so see, macro, very rightly, as Hiren also said, we spend probably 1% of our time on macro. Maybe a year like last year, we spent 1.5%. We take the consensus out there as a given. I mean, last year, if we were sitting in January or February first week, GDP growth rate 5% or 6%, right? So that's the context. As Hiren put it, macro is for context. So you build your financial models under the assumption that GDP growth will be 5-6%. We are not trying to fine tune for 6 to 7% or 4 to 5% or 5.5% or whatnot. That's irrelevant. Secondly, when I said that we have been all the time wrong, 100% of the time wrong, what I meant is not like, so there are 2 ways to be wrong. When a student gives a, let's say, math exam, you all have taken math exams, either you can be 98 out of 100, 99 out of 100, or you can be 35 or 45 out of 100. So when I say wrong, what I mean by is we've never got 100 out of 100, and nobody, the design of the exam is such that nobody gets 100 out of 100. Like languages, you never get 100 out of 100 in English or Hindi. But still, it doesn't mean it's useless or pointless. It's extremely important. And the goal should be to get as close to right, recognizing that you'll never get it right, but get as close to 100 as you can all the time. And the closer you get, the better is the insight, or the better is the power of that as an input to your investment decision making.
Got it. Okay. Now let's put this into context. We have about 13 minutes left. We've established that the direction seems to be upwards. Now maybe we can't time a decade, or maybe none of my esteemed guests can also speak for a decade out. But the near term, next 3-4 years, everything staying constant, don't seem to be that bad. Andrew, I take on board. I want to come to you on this. I take on board the point that there could be near term hiccups because of what the globe will do. But since it's difficult to time that, let's ignore that and let's get onto the point that you made about now that the direction is right. What do you do? Hiren made a very important point that at times in turnaround stories, you maybe don't even look at the macro. But my question to you, Andrew, is this, that the last decade, if you will, we've kind of given a lot of importance to predictability and certainty because the world was a bit uncertain. If the world is looking a bit more certain right now, do you reckon that the markets will reward the uncertain names which are making a bit of a comeback? Will value get rewarded?
One is that, to my mind, it's quite simple, right? If you're having a global recovery, which you are, and we'll have an economic recovery here in India, then the broader market is going to be the place you need to be. I mean, the last 3 years prior to that, it's been a small number, handful of names which have done well, not just in India, but that's been a global trend as well. But if you're having a global recovery and you're having an economic recovery in India, then it's going to be your broader sectors and broader companies which will do well. So, it's going to be led by banking, industrials, consumer discretionary, and energy. Now, whether it's in that order, I don't know, but all of those will be the drivers of the market. Has been before, will continue to be again, because, if the economic recovery is across a broader base of industries, then, you are going to see these sectors being the best. And whilst we'll love the Unilevers and we'll love the Nestle's, they're not going to excite us for the growth in earnings that you're going to get from these types of sectors, which have got that huge operational gearing. If India is going to be a $5 trillion economy, you're going to have a banking sector which is sizable to be able to have that type of economy. So the whole banking, financial services sector is just going to boom, completely across all different sectors. Now, whether you want to be in the insurance side of it, the banking side of it, NBFC side of it, you'll look at those trends. Asset management side of it, you'll look at those trends and say, who's got the biggest delta in terms of earnings growth going forward? Where do I see people putting their money going forward? And that's all we're doing at the moment. We're just looking at those trends. Those are the broad sectors we're looking at, but there'll be other sectors, which will come into that fold. If it's a global economy recovery, then obviously the commodities sector will do well. From where it is today. The only thing I would say on macro, I just want to go to one quick point on macro, where I think it is important to follow macro, is the global macro. Because if I take commodities, for example, India's a price taker. We're not a price giver. We don't have that. We're not that capable. So if the global economy is falling, commodity prices are falling. Therefore, you don't want to be in a Tata Steel or XYZ. So the global macro, whether it's interest rates, commodity prices, or currencies, will have an impact on India. It could be positive or negative. So the global macro has to be taken into account. And that's why I say short term, I worry about some of these factors. But if I take the longer term trends of the Indian economy, and the budget, ticked all the right, but I'm not going to go into that. But I've for 20 years of me being in India, this is only second time I've actually said I've liked a budget. It was, very, very strong in terms of hitting the right note. So I think that gives us an extra impetus now for corporate India to go out there on a front foot and start doing things.
Which was the other time, Andrew? Most people said 91 or 97. Which was the other time?
Chidambaram. I think it was Chidambaram was 98, 97 or 98. Yeah.
Okay, fair call. Yeah, 22 years back. Hiren, question to you. Because the topic is about whether this can be the best wealth creating decade, At these uh, times, when you mentioned it's an inflection point, are you getting decadal ideas? I mean, you may invest in them not necessarily with a hard and fast view that मैं 10 साल रखूंगा, but you see that this business has the power and the management quality, etc., all fits in. But are there businesses, are there themes which are looking decadal to you?
There are. I mean, if you let me give you an example, and I'm not professing that I will or one should not, but let's say if you look at the real estate industry, right? It's coming out of a 10-year consolidation, right? There are many such sectors where, or companies or sectors where peak profitability that in absolute terms that many of these companies reached was probably last when they reached was in somewhere between FY10 and FY12. And then it was a kind of a downhill, right? So I think whether it is selective capital goods, whether it is construction companies, whether it is real estate, there are several sectors which are coming out of long periods of consolidation. Let me give you an example. Pharma itself, before it made a move during the COVID time, I mean, for 5 years, did nothing, right? Maybe because the industry was going through a tough period, right? Real estate I mentioned because typically what we've seen is that any sector that gets regulated and has a proper structure around it, we talk about reforms, but the first thing that happens is that initially, in the initial period, reform brings a lot of pain. And once you go through that cycle of pain, then whoever is the survivor, there is a massive headroom for growth, right? If you go to many big cities, there were so many developers. I think 90% of the developers or 95% of the developers have vanished, right? So while there was demand side softness, but the supply side got destroyed even significantly because of the tough period and the reforms like RERA that happened. Now, whoever is left and survived, as the demand comes back, and we've seen the conditions are so favorable. I mean, we are seeing decade low interest rates, housing loan rates, right? And the sector hasn't done anything for a long period of time. Many stocks are coming out of their 10-year vanvas, as they call it, right? So I think that, and even though, the last 10 years at an aggregate level was not great, but there were sectors where you made phenomenal money. I think the last decade was a golden decade for consumer companies. I mean, you got earnings growth, you got phenomenal multiple expansion, and people made a lot of money. And I keep giving this example, right? 2000 to 2010 decade, if you bought a Hindustan Lever, your 100 rupees became 144, including dividends. But if you bought an L&T in 2000 and sold it in 2010, you made 1400 rupees. And then the scenario completely flipped after 2010, right? L&T did nothing from 2010 to 2020, and Lever gave you phenomenal returns. So I think these cycles across sectors will happen. I think definitely as we've seen 3-4 very significant reforms in the last few years, from GST to RERA to IBC. And then on top of that, we had the COVID crisis, right? The survivors of these last 3-4 years of, very tough macro, as some of these get out of these, you will see a lot of opportunity to make money in them. But the question again, people make this as a question of this versus this, right? It's not this versus this. It's about how you blend your portfolio. How do you want to, create a combination of opportunities? And then every cycle then has completely new sectors which were not there. Like electronic manufacturing is a completely new cycle. There's only probably 1 or 2 companies. I'm sure there are many more companies which will get represented in the stock market, because it always happens, right? There were a few specialty chemical companies. Suddenly the sector's doing well, the market's rewarding it. There are so many IPOs from specialty chemical companies that come in. So I think the way I look at the next decade is that there are many sectors that we will have to study, which have not done well for the past decade, which may be emerging out of long periods of consolidation. And secondly, you will have to look at completely new opportunities, because as the structure of our economy changes, right? So also there will be a new set of opportunities which will emerge. Where did we have QSR companies, for example, right? They were great growth companies in the last few years, and they will probably be great for the next 10 years as well. So I think, yes, there is time to look at some of the beaten down sectors, or, sectors which didn't do well. Now, that doesn't mean that just because it didn't do well, it has to do well. I'm saying that's the starting point you go with. Then obviously you put your context, you see, why you think it can do well, and then you place your bets.
Yeah, and that's a very valid point. Prashant, can I come to you for the final question of this session, and which is the other part, wherein let's assume that some of the value stocks will do well because they are coming out of economic recession, so on, so forth, etc. But when you look at, let's say, the previous decade, there were some blue chip companies trading at premium valuations which continued to stay that way. Do you reckon, and the answer would be a yes, that there will be companies which are trading at premium valuations which will give you tremendous wealth generation, but are there identifiable opportunities like that? Are you at White Oak also trying to get into areas or sticking to areas wherein the valuations may be stretched, but you reckon that for the foreseeable future things will continue to look rosy? Is that a large proportion of your portfolios?
Thanks, Niraj. So see, at White Oak, what we do is looking for the best combination of business and value. Great business and attractive value. There's no point in owning a great business if there's no value in it, because there are other great businesses where there might also be value. So, if I can't take names, but if you have, let's say, 20 great businesses and 5 of them no longer have any value, take the money out and redeploy in the other 50, or find other 5, because there are many, many great businesses out there. So to your point, we do not own any company where we believe there is no longer value. Now, our definition of value might be different from what we do not look at PE multiples at all, for example, and focused more on cash flow based DCF and other cash flow metrics. So that is one. Second, to the question of whether we look at areas, we don't think of investing in terms of areas, as you know by now, Niraj. In our view, there's money to be made, tremendous lot of money to be made in a wide range of sectors, and no need to limit to any theme that might be in favor as of particular day. We started the team White Oak in June of 2017. People had written off IT services back then because of automation, machine learning, XYZ, ABC, and 2017 was a gaga year for Indian market with mid caps, small caps in one of the finest years. People only wanted to be in domestic oriented cyclical sectors and completely neglected IT companies. If you look at our since inception numbers, 3 out of the top 5 performers by a long margin is IT services companies. Because even at that time, in fact, when everyone is neglecting a certain sector, you might find a stock specific opportunity which is phenomenal. Real estate that Hiren mentioned over the last decade was terrible. A lot of people completely ignored real estate for the last 10 years. But people who would have identified opportunities in there, because it has been a neglected sector, you would find, some of those names would have made tremendous amount of money. So it's not that we're only looking for neglected sectors. There are opportunities, money to be made in neglected sectors, money to be made in loved sectors. It's all company by company is the only point I'm trying to make.
Okay. Well, I would love to explore this a bit more, but we've run out of time completely. So to all of you, thank you for giving your wisdom. Andrew, we will remember that while global macro may not be playing a very large part, but it does impact a bunch of themes, and therefore even in a dominant decade, makes sense to look at it. Hiren, same point, while people may look at macro, maybe looking at companies and what they are saying might be a better way to approach this whole investing theme. And Prashant, to you, very valid point and a good learning about how you can make money even in spaces which people might be believing are very expensive. Don't look at just themes, maybe bottom up might be better. Thanks so much, all of you, for speaking.
Pleasure, great pleasure to see you all. Thank you.
Thank you, everybody.
Thank you. Aishwarya, over to you.
Thank you very much to to the weaver of the session, Mr. Shah, who's again done a wonderful job at steering the session. And of course, a big thank you to our luminary eminent speakers. Thank you to each one of you for your significant contributions to this panel discussion. Now, ladies and gentlemen, while the last session was more about micros and businesses, the upcoming session is about sectors, themes, and overall economy. And very quickly, you will see our very eminent panelists, Mr. Anup Maheshwari, Mr. Dinshaw Irani, Mr. Naveen Agarwal, Mr. Vikas Khemani, and this next session that's coming up, themed India Over 2020-2030 presents once-in-a-lifetime opportunity for wealth creation, but for those who see it through the right lens. And the session will be moderated by Mrs. Lakshmi Iyer. But again, like we always do, we just take a 2-minute break so that we can get all the panelists together on the screen. So just give us about 2 minutes for that technology doing that we have to do, and then we will be back. Ladies and gentlemen, thank you very much. On the other side of this break, very interesting session awaits. So please stay with us. Thank you.